My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey, gang, welcome back. Today we have a very experienced real estate operator zooming in from the beautiful city of Houston, Texas. We've got Tyler Evans with Aligned Ventures, and Tyler and the gang, they focus on multifamily properties, primarily in and around Houston and in Texas. And Tyler's been around the block once, twice, three times. He's been in this whole crazy world of real estate for at least 18 years. This has been his main profession, and he's kind of worked his way up. You know, he worked through working with big companies, and then he got the bug and he said, you know what, working for the big guys is good, but being my own boss is even better. So that's what he's up to these days. So Tyler, welcome to the show. Great to have you.
Yeah, pleasure to be here. Thanks.
Yeah, my pleasure. So Tyler, tell us a little bit about Aligned Ventures, a little bit of just a short background on the company, and then let's take a look at what your buy box is when it comes to multifamily.
Fair. So, a little background. We've been in business for about 5 years. We've acquired a few assets in the Houston market, typically some kind of value add deal. So my partner and I, we focus on really preservation of capital and deals that have, clear path to upside. So pretty simple plan there. As far as buy box, we're really focused on mid 80s and up deals, around 150 to 250 doors. We look for definitely no chillers, no flat roofs, and not really heavy lifts right now. I think, there's always a difference in the market cycle on what you go after, right? The last 2 years, everybody chased, hey, we're going to value add, we're going to renovate this unit and slap on $200 rent bump and everybody's happy. You can't really do that anymore. And, and a lot of these heavy lifts you have to do where you're putting all this capital into the deal, it's hard to ensure you're going to get that back. So we're really chasing deals that have operational expense plays where we could come in, optimize operations, get it running really lean, smooth, maybe put in a few value add things like cable is really big right now, where we could add value to the resident and the property. So that's really what we're chasing. We just closed a deal yesterday, in fact. Thank you. Yeah. It was a challenge getting it there, but super happy it closed. But yeah, that's exactly what that deal is. Similar box.
Is that the Green Free Place one I see on your website?
Yes, sir. That's the one.
Yeah, nice. 200 units. Very nice. Awesome. So Tyler, let's back up a second. So you've been in the real estate game for a long time. I think you were involved a lot with operations with a large company. Were you part of like property management as well, or kind of back in?
Yeah, it started in property management. Yeah, leasing apartments and just really worked my way through the whole operations field and got to where I was running portfolios. And then, like you said, made the decision to kind of jump to the ownership side and use all those skills I've acquired, for my own benefit instead of somebody else's.
Well, that makes a ton of sense. You learned a lot with those other positions, and you jumped in at a kind of a go time. So if you guys have been going for 5 years right now, or February 2026. So you jumped in kind of at the peak of the market, which might have been good, but then things kind of cratered for a little while there. That must have been a tumultuous time for you guys.
Absolutely. I think it's been a roller coaster ride. We had a really nice run up on the market cycle, really 7, 8, 9 years, you couldn't lose. You bought something and just went up. Yeah. We got in right around the COVID time, and everybody thought things were going to crash. It was a really weird time because, multifamily, you really base everything off of statistics. You're looking at employment numbers and jobs and supply and demand.
Pandemic happens. What the hell?
Yeah.
What happens to the statistics?
The metrics were crazy. You had, unemployment, and it was really hard to have a basis. And on top of that, everybody thought it was going to crash, but it skyrocketed.
Yeah.
So prices went to all-time high transactions. So we kind of made us take a pause. And we're like, okay, what's going on? Let's see what the market's doing. And we decided the best way to buy would really be cost basis. We wanted to buy something at a really good price, because regardless of what happens, if you buy right, then chances are you're going to do well on the deal. So we were really shopping for purchase price per unit. And so
that must have been tough early days when everything was go, go, go.
It was, yeah. It took a lot of shopping, a lot of broker calls, and a lot of deals that I looked at, but ended up finding an amazing deal. Price, I would say probably the best price deal in Houston at that time. So we took that down and had really good success with that. And then the next year, kind of the same thing. We're looking for really good cost basis. I'd been shopping this deal for probably a year. It was off market. I'm talking to the guy and I'm like, hey, how about this number? And he's real hard to nail down. And then finally he listed it with the broker. The broker calls and he says, yeah, I know you've been working on this one. He's like, do you want to put it in offer? And so finally he was able to close that one. But yeah, then we get into 2023 and, the market's just in a really weird place where, values have kind of dropped a little bit because expenses went up everywhere. But the sellers are riding this high, and they're like, my property is worth more than it's ever been.
Reality hasn't come crashing down.
Exactly. There's a big lag there. Nobody wants to admit that their property's dropped in value, right? It's a hard pill to swallow. So
especially try to explain that to your investors and your partners.
Yes, yeah, that's the main thing. Especially when for the last 7, 8, 9 years, no values have dropped. So it's like, what do you mean it dropped? That's not something that happens in real estate, right? So we just kind of, we took a step back. We put in a few offers, but all the comps were still, the competitors were still too high. So we're like, you can have this one. We're just going to, focus on internal operations. So we built an internal property management company during that time, took over operation of our assets. And so made the best of it. Rates jumped up shortly after that, causing, a lot of turmoil in the market where really nothing penciled for the next year and a half. Yeah. So we
frustrating,
very frustrating. But yeah, we just stood our ground. We're like, all right, we're not going to buy. Nothing makes sense. Focus on operations. And then 25, we saw things start to turn around a bit. So we started underwriting a lot of deals. There was still that bid-ask spread where the sellers they're getting more realistic. They're not quite there yet. So I think we were best and final on 10 deals, where we were right in the running. We got second place on like 8 or 9 of them, which is super frustrating.
Yeah.
But then, finally got this one in contract towards the end of the year. But going to NMHC this year and just talking to people and seeing deals that are coming to market, man, I think the market's just in a really good spot to buy right now. Yeah. So, I'm seeing that finally deals, you can underwrite them and they actually make sense. You're buying them at, say, a 6.5 cap or a 6 cap, depending on what class. And, you're getting a 5.5 fixed rate debt. So, you actually have some positive cash flow there. And if there's upside, then, if you're going to improve operations or improve rents, then that's just going to continue to grow as you hold the property. And so, this makes sense again for the first time in quite a while.
So what does the portfolio consist of currently with the new one you just closed on today?
Yeah. So we have 3 assets, right around 450 doors. So we're ready to buy, hopefully about 3 more deals this year. So
wow. So you want to double the portfolio this year?
Yeah, that's the goal. I mean, like I said, it's really just been, as you said, it's been a challenge since we got into this. It hasn't been the time to buy. And, kind of our number one thing is capital preservation. We put, 20% of our own money into every deal we do. So, we're at the end of the day investors. And so our number one thing is like, let's make the right buy and the right business plan and to protect this money. Right. And so it's been, a little challenging to do the past few years, but like I said, looking at the deals going into this year, they just make sense where we feel like we can deploy a lot of capital and buy some really good deals. And also just looking at the future, looking at Houston in particular, because a lot of it is about supply and demand, right? It's, and Houston, who usually has the most oversupply in the country, they actually haven't been building the last few years. And so we have, probably in the next year and a half, we'll have, a need for more housing but nobody can really build right now because, labor is really expensive. Rates are still high. Materials are high. So it's very difficult for these builders to make deals work. So we have not very many new product in the pipeline, but yeah, we still have a lot of people moving here. It's a very affordable city, offers a lot of jobs. So, as the population increases, the existing assets should be able to absorb a lot of those people. And, for the first time in a while, we should see some organic rent growth again, as occupancies go up and rent go up again, because, it's been a few years.
The question I've got for you then, Tyler, is, you were kind of in a holding pattern for a few years, which makes tons of sense.
Yeah.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. No deal is way better than a bad deal. Now you've got this most recent acquisition, and you're ready to jump on more because there's more coming down the pipeline. I guess the question would be around raising capital then. I've spoken to a lot of operators, and what they're seeing is a lot of LPs are really gun shy because they've been burned with other operators, other deals. So they got spoiled with those go times, especially early 2020s, right? And then boom, their money's either stuck in deals that are kind of floundering, or they've actually lost capital. What have you been seeing as far as like investor sentiment these days?
Yeah. So I think you're right. Across the board, that's pretty much the story. People got in some bad deals where they just, the sponsor either shouldn't have bought it, is just riding that wave and didn't.
Oh yeah, 2020 hindsight, and then some reading, that's for sure. Yeah.
Yeah, 100%. But at the end of the day, it's really the investors that paid that price. So, I think they learned a lesson, and they're a lot pickier on the type of deals they're going into and the business plan. And that's something we try to do for investors, whether they're going to invest with us or not, is like, hey, here's what to look for. We wrote a little guidebook. Like, we put a lot of money into this as investors. Like, ask your sponsor these things, right?
Right.
Like, what's your exit cap? What's your entrance cap? How are you getting there? What's the market? Just like these key little things that help you kind of pick apart their underwrite to see, is this a good deal? Is this a safe deal? So, but as far as our raise goes, I think we're a little fortunate. We're kind of going at it backwards, which is an interesting way, right? So we have enough balance sheet capital for us to go ahead and close this deal without investors.
Nice.
So, like I said, we closed this deal yesterday. Now we're really going to start pushing our capital raise. And I think it's an interesting story because it's not, hey, we're going to get this deal. We're going to cut cost day one, and we're going to do this and that, right? It's a story that, hey, we already own this. We've already cut insurance. We've already cut the rate. We've already done this and that.
Yeah. Plus, we put in all of our own cash to buy this thing.
Yeah, that's
we got it. We got it kind of optimized now. Now, would you like to come along for the ride?
Exactly. Like, we're cash flowing day one. Like, come join us, right? So it's kind of an interesting way, but I think it's a little bit more attractive, hopefully, in this market, just given what people have gone through. So. But yeah, you're 100% right. A lot of the other sponsors I know that are raising capital, they're like, yeah, it's a little challenging. The people that have invested in a lot of our deals before, they got into a bad deal, and now they're just waiting to make sure that it's going to be good again.
So you're talking a little bit earlier, Tyler, about value add, kind of the meaning of that changing for you guys nowadays. So remind me again, what does value add look like to you and Aligned Ventures? What are you guys looking to add? How are you looking to add value if it's not the typical renovations and whatnot everybody thinks of?
When I think of value add, what really comes to mind for me is like, what's something that's going to benefit the residents, that they actually want? Because, a lot of times, especially right now, and that's why I don't think renovations are good, is because people are pinched. the economy is tight.
They don't want to be paying more rent. They're going to move
That's
out
right.
to get you.
Exactly. Yeah. It's like, you can't just throw on, hey, I know we'll add valet trash. It's like at the end of the day, I think most people are like, I'll just walk my trash to the dumpster. I'm not going to pay an extra $20, right?
Yeah.
And you keep piling on enough fees, they're going to leave to save money. So, I really like the internet. So I've been shopping a lot of vendors for this current deal. I thought I had a really good price, kept shopping. I got it down another like $5 a month for the service fee. So the current offering that I have, I'm going to be able to get these residents, 2 gig internet speed for about $50 a month. We did
compared to what would they be paying right now?
Yeah, right now they're paying around 70 on average for slower speeds, probably like 1 gig. I'm sure some people.
And the one they're currently with is not a revenue generator for you guys. Would that be safe to?
Yeah, they have a marketing agreement. They make maybe a couple hundred a month on that, right? So not much, but we'll be able to generate around $22 a month per unit. Nice. and give the residents faster speed. It's fiber, which right now they have coax, so it's a better product at a better rate or equal rate to what they're paying now. So it's a big value for them. So they should be happy that, oh, okay, thank you for bringing this, right?
And if you got 200 units at $22 a pop, that starts to make a difference in the net operating income for sure.
Absolutely does, yeah. So you add 40, 50,000 a year in net operating income after expenses, and you do that at your exit cap, and you created $1 million of value for this deal.
Nice.
And the residents are happier. So it's a win. Yeah. Another example. So this property had a fire like in 2015 or something. Building burned down. They just cleared the slab. It's right next to the office. Instead of a fence around it, it's just an eyesore, just sitting there doing nothing for anybody. And they could use some more parking. So, hey, common sense. Why don't we take this big giant slab and, create 15 parking spots here and charge them, $25. And because there's, people that live right in this area, in this little courtyard. So it's like, if you want to live right by your front or park right by your front door, like it's going to be a value, and it's optional. It's like, hey, if you want to,
they can park away if they don't want
it. Yeah. So, that's something that they value. So they're going to pay. So I think it's really finding those things that brings the tenant a positive experience that they're willing to pay for versus just kind of shoving something down their throat so that you can make more money. So
that's good. No, that makes a ton of sense, Tyler. That's for sure. Well, hey, congratulations on landing this most recent deal. I can tell that's awesome. And great targets for this year, that's for sure. So going after 3 more deals in 26, that is a fantastic target to have. If people are listening or watching this and they'd like to connect with you, what's the best way for them to do that?
Yeah, you can find us online at investav.com. You could book a call. Happy to just chat about multifamily investing, and we're happy to go over our new deal with you. So reach out.
Awesome. Hey, Tyler, thanks very much for being on the show.
My pleasure. Thanks for having me.
All right, everybody, take care, and we'll see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.